All right, everyone, it's about 5 minutes past 8, so I'm going to go ahead and get started here. Welcome to this direct instruction for Unit 4, based on capital structure and a couple concepts that you guys will be working on this week and going into the weekend. For this particular session, the learner should be able to understand the four common structures of funds in capital structure, understand stock splits and stock split reversals, and also know how dividends are paid out to investors and why that happens. So the focus of this particular week's session has been on the capital structure of different businesses and firms. As you may know, that the capital structure is a mix of the firm's debt and equity sources of funds. Each company structure is different, but oftentimes you'll find that some similarities amongst certain industries. Particularly, you'll find that in companies that are capital intensive industries, such as like the oil or gas refining, where ultimately anywhere where there's huge amounts of funds that are needed up front to produce the product before it's actually sold. So typically those are going to be the ones that are going to have similar capital structures. You'll see it, they'll have similar debt to capital or debt to equity ratios amongst them. So the focus of this particular session will be to focus on the four main structures, or the four basic sources of funding for firms, which are preferred stock, common stock, long-term debt, and also retained earnings. Retained earnings are funds that a company already has. So we're not going to cover too much of that during this particular session. So ultimately, we're going to focus on preferred stock, common stock, long-term debt, and also and we'll also kind of talk about a couple of their things towards the end. So just get us started, I do have a short video on preferred stock, on the differences between preferred stock and common stock. You'll see a little bit here in the graph, but you'll also just take a watch of the video I have. Just give me 1 second to get it playing.
Okay, common stock versus preferred stock. Again, the reason I put both of these up here is that in order to understand what each of these is, it's easier to understand what they are in relation to one another. Common stock and preferred stock are different classes of stock. What does that mean? It means that the common stockholders and the preferred stockholders have different rights inside of the company. And those rights are referred to as, the reason preferred stock is referred to as preferred stock is because it generally has a bunch of preferences, and that common stock does not. So we'll talk a little bit about the differences between preferred and common, and then we'll do separate videos on each of these concepts so you can understand them in a little greater depth. So first of all, just a reminder, stock is shares of ownership. So some deals might be all common stock. Common stock deals are it's pretty uncommon if you have an investor that comes in that they don't demand preferred stock, but some deals will be all common. Also, really important to mention that options that go toward employee compensation, options are almost always common stock. So you won't have any of the preferences that a preferred stock shareholder will have. And you can read some of these preferences. There are things like special voting rights, and liquidation preferences, dividend preferences, redemption rights, and dilution preferences. And we'll go into each one of these in greater detail in their own video. But the overall thing to understand between common and preferred stock is that preferred stockholders really have most of the power and preferences and sort of things leaning in their direction, the advantage, if you will. Whereas common stockholders are kind of at the bottom of the food chain. Importantly, when you go to sell a company, there is an order in which everyone gets paid, very simply. And that order is debt, meaning your debt has to get paid off first, and then usually the preferred stock shareholders get the value of the company, and then the common stock shareholders. This may look familiar to you if you know anything about bankruptcy. It's the same kind of concept. The preferred stock shareholders just come before the common stock shareholders in terms of value inside the corporation.
I'm Larry Walther. This is principlesofaccounting.com, Chapter 14. And in this module, we are going to very simply look at features of common and preferred stock.
All right, so now that we're back here, just a couple other things to add to the discussion there on preferred versus common stock. It's important to remember that preferred stockholders are implicably paid out first. So if a company decides to issue any dividends or anything like that, until the preferred stockholders get their share, a common stockholder will never be paid out anything. So that's one of the more important things, especially if you're looking to invest in a company. You want to see, just how many preferred stockholders they have, because that could greatly impact, when you'll actually get a dividend, and likely if you actually will get a dividend, because if they don't get theirs, there's no way for a common stockholder to get a dividend also. All right, so moving a little bit ahead, we do want to talk a little bit about long-term debt. So, common sense would probably tell you that, no one wants to have debt. As you can see from the little guy at the bottom here, debt does appear to be a burden, and it can be a burden on most people and even a company. So common sense would tell you that a company would not desire debt, but in actuality, debt is actually the least expensive form of capital that a company can get. The reason this is because debt is actually considered desirable because the interest cost associated with debt is tax deductible. What this means is that the interest cost lowers a company's net income, and in turn lowers the taxes that the company pays. Ultimately, the disadvantage to debt is where your common sense is correct. At a certain level of debt, which we'll likely discuss in a couple, I believe next week. A company that's carrying too much debt in its capital structure has a risk of having a very high credit rating, because of the debt service levels that they're carrying. And ultimately, it won't look good for their capital structure, and they'll look like a much more risky company to invest in, and ultimately lend to as well. As you can imagine, as an individual person, if you have a lot of debt, lenders are less likely to give you additional money to add on to that debt. So sometimes having a lower amount of debt to equity ratio is a much better position to be in. And that also can affect the rates that you get. Typically, as an individual, if you have a high amount of debt, you're typically going to get a higher interest rate than someone who comes in with no debt but still has a good credit rating. So quickly, I did want to just do a quick conversation on stock splits. I do know we discussed this a couple weeks back, but ultimately, because you do have a discussion this week that's focused on stock splits, I did kind of just want to go over really quickly, what a stock split is and how it works. Basically, a stock split is a corporate action in which the company divides existing shares into multiple shares, just to basically boost the liquidity of those shares. You'll see, you may have seen Apple has done stock splits in the past. Most companies at some point have done some sort of stock split with the intent of, making a share that costs much more affordable for the everyday investor, which ultimately can help the people that hold these shares to be able to sell parts of their investment as opposed to having to sell all of it to raise cash or, for different liquidity reasons. The reverse stock split is pretty much the opposite. This is when the company is looking to boost up its share levels, to boost up its share price. Typically, you'll see this, with companies that have, kind of run into some trouble, that were already kind of trading on the lower tier of things. Typically, anything under $5 is considered a penny stock. So most companies will try to stay far away from being under $5 a share. So in that situation, you could see a reverse stock split where they'll say, okay, we're going to take, for every 5 shares, let's say their stock is trading at $5. Let's say they'll say, okay, we're going to take 5 of your shares and give you 1 share of this reverse stock split, which basically means now you have, as opposed to having 5 shares worth $25, now you have 1 share that's worth $25, which keeps the company out of the penny stock, range, which typically for companies that are more established, it's not good to be considered a penny stock when you're a company that's been around for quite some time. Finally, I do want to talk a little bit about dividends. Once again, we do have another discussion that's kind of focused on dividends. Dividend is basically just a payment that comes from the company. It's either in cash or it could also be in additional shares of the company. And typically, this always is going to go to shareholders that are on record at a certain date, which is normally set by the board of directors, where they say, okay, anyone that's going to get a payout, they have to be invested within the company before this particular date to get this specific payout that we're recommending. The distributions, if they're paid out in stock, they're going to say that you're getting 0.5 shares for every single share you hold. Whereas if it's paid out in cash, they're going to say you're getting 10 to 15 cents per each share that you're holding of the company. Other than that, unless anyone has any questions, that's all I have for you guys this evening. As always, you can feel free to call me, email me. I do have my office hours every Wednesday. And besides that, have a great night. And I look forward to seeing what you guys produce this week.